Silver has just crashed 40% in only 2 months. Across the financial world, investors are panicking, dumping their physical holdings and declaring the precious metals supercycle completely dead. But before you sell your stack, you need to understand something crucial about market history. This exact magnitude of a sell-off under these specific macroeconomic conditions has only happened 2 times in the entire recorded history of the silver market. The outcomes of those 2 events were violently different. The first time it happened, it triggered a brutal, agonizing 90% decline that trapped investors for 20 long years. The second time, it was the ultimate bear trap, immediately preceding an explosive 10 times rally that minted millionaires overnight. Right now, silver is sitting exactly at the precipice of one of these 2 outcomes. Today, we are going to look past the mainstream noise and break down the data point by point to figure out which historical path silver is about to take. Let us step back for a moment and examine the emotional psychology driving this current panic. When you see your portfolio bleeding red day after day, human nature screams at you to liquidate everything and run for safety. The mainstream media feeds on this exact fear. Every single morning, financial news networks flash terrifying headlines, practically begging you to surrender your positions to institutional buyers waiting in the shadows. But wealth is never built by following the panicked herd. It is built by remaining cold, calculating, and ruthlessly objective when everyone else is losing their minds. We are going to analyze the structural deficit in physical supply, the highly unusual behavior of institutional short sellers, and the terrifying macroeconomic indicators flashing red across global markets. I will show you the exact charts the big banks are looking at behind closed doors. By the end of this video, you will have a crystal clear framework to make your own decision. You will know exactly whether this current 40% drop is the absolute worst financial trap of our generation, or the single greatest generational buying opportunity you will ever witness. Let us dive into the charts right now. To understand the nightmare scenario, we have to travel back to the climax of 1980. Inflation was raging, and the Hunt brothers had cornered the silver market, driving the price to almost $50 an ounce. But when the regulators changed the rules, the price collapsed 40% almost instantly. Many investors bought that dip, assuming the bull market would continue. They were dead wrong. Over the next 2 decades, silver entered a brutal winter, losing roughly 90% of its peak value. The critical data point here is real interest rates. When the Federal Reserve hiked rates to double digits, they crushed inflation and simultaneously crushed the speculative demand for non-yielding assets like silver. Today, we are seeing aggressive rate posturing from central banks. If the current economic data mirrors the monetary tightening of the early 80s, this recent 40% drop is not a buying opportunity. It is the first warning sign of a multi-decade bear market. You have to realize that in 1980, the psychology was entirely different. Everyone believed silver could only go up forever. People were literally lining up around the block at local coin shops, desperate to trade their paper cash for any scrap of silver they could find. This was the ultimate retail top. When the price broke, it did not just dip, it shattered the dreams of an entire generation of savers. For 20 long years, silver became a forgotten asset. Mocked by Wall Street and ignored by the mainstream public, the price languished between $4 and $5 an ounce, while the stock market embarked on one of the greatest bull runs in human history. If you were holding silver back then, your opportunity cost was astronomical. You were watching your neighbors get rich in tech stocks, while your silver bars collected nothing but dust in a safe. Now, let us look at the modern parallels. Are we seeing that same retail euphoria today? Not exactly, but we are seeing central banks fighting a similar battle against rising consumer prices. When the Fed moves to raise interest rates above the rate of inflation, it creates a massive headwind for precious metals. Why hold a metal that pays 0 yield when you can get 5% or 6% on a government bond with virtually 0 risk? That is the fundamental trap. If the central banks succeed in killing inflation without crashing the global economy, silver will lose its primary appeal as a monetary hedge. We could see a repeat of that 1980s bleed out, where the price slowly grinds lower year after year, exhausting the patience of even the most dedicated gold bugs. We also have to consider the role of the US dollar. In the early 80s, the dollar entered a period of massive strength that lasted for years. Because silver is priced in dollars globally, a surging greenback acts like a heavy anchor around the neck of the silver price. If we are entering a new era of dollar dominance and high real yields, then the 40% crash we just witnessed is merely the beginning of the end. But before you conclude that this is our current reality, we must look at the structural differences between then and now. The world of 1980 did not have the massive industrial demand of the 21st century. It did not have the sovereign debt crisis we face today. However, there is a second historical precedent, and it paints an entirely different picture. During the liquidity crisis of 2008, silver suffered a terrifying collapse, plummeting alongside the broader equities market. Weak hands panicked and sold everything. But that crash was a pure liquidity event, not a fundamental shift in supply and demand. What followed was a historic recovery, leading to a massive rally where silver multiplied its bottom price by almost 10 times. We must look at the physical supply deficit. Unlike 1980, silver today is a critical industrial component. Millions of ounces are consumed annually by the green energy sector, solar panel manufacturing, and electronics. Right now, global silver demand outpaces mining supply by hundreds of millions of ounces per year. If this recent crash is just a paper market liquidity wipeout, then we are looking at the exact same launchpad we saw roughly 15 years ago. Think about the physics of a coiled spring. In 2008, silver was crushed because every major hedge fund was facing margin calls. They sold it because it was the only thing they had left with any value to cover their losses in the housing market. When the selling stopped, the rebound was violent. Within 36 months, silver went from under $9 to nearly $50 an ounce. Today, we see the same signature. While the paper price is crashing, the physical premiums at your local coin shop remain stubbornly high. Look at the photovoltaic industry. In 1980, solar power was a laboratory experiment. Today, it is a global infrastructure necessity. Every single solar panel requires about 20 grams of silver. As the world pushes for a carbon-neutral future, the demand is projected to double. We are not talking about a speculative bubble. We are talking about a structural necessity for the modern world to function. Furthermore, look at the debt levels. In the 1980s, the United States debt to GDP ratio was around 30%. Today, it is over 120. The central banks simply cannot keep interest rates high without bankrupting the entire federal government. They are trapped. When that pivot happens, the floodgates will open. Money will pour out of devaluing fiat currencies and into hard assets. While the paper traders are crying over their digital screens, the industrial giants are quietly buying up every physical ounce they can find. When that day comes, $40 silver will look like a distant memory, and the journey toward triple digits will begin. Are you watching a dying asset, or are you watching the greatest bear trap in the history of finance? So, which era are we repeating? To find the answer, we have to look under the hood at the commercial banking data and the physical vault numbers. Currently, the registered silver inventories on the primary exchanges have fallen to levels not seen in over 5 years. Yet, the paper price has crashed 40%. This massive divergence between the physical reality and the derivative market is the key. In the 1980 crash, vault inventories were actually rising because the high prices brought scrap silver flooding back into the market. Today, we are seeing the exact opposite. Even with the price dropping, mints are completely sold out and industrial buyers are quietly draining stockpiles. Furthermore, institutional short positions are reaching extreme exhaustion levels. The smart money is using this panic to cover their shorts, preparing for a reversal. Let us look at the hard data from the first quarter of 2026. In the month of February alone, registered silver stocks fell. Stocks on the COMEX fell below the critical 100 million ounce threshold. On a single Tuesday, more than 3 million ounces were withdrawn. This is not the behavior of a dead market. It is the behavior of a vacuum. The leverage becomes a ticking time bomb. The paper-to-physical ratio has recently been estimated at over 350 to 1. For every physical ounce, there are 350 digital promises. Now, consider the international arbitrage. In the Shanghai Gold Exchange, silver is trading at a $10 premium over the Western spot price. In a rational world, silver would flow instantly from the west to the east, but it is not happening at the expected scale. This suggests Western silver is either spoken for by industrial giants or simply is not there in the form required for immediate delivery. We are witnessing a fragmentation of the global market. Physical bars are being hoarded by sovereign entities and massive technology firms. Let us talk about the Commitments of Traders report. Large speculators have slashed their long positions to a 2-year low. Meanwhile, the commercial banks, the smart money, have been aggressively covering their shorts. Historically, when they stop selling, the bottom is in. We are seeing the same technical setup that occurred right before the massive breakout of 2025, which saw silver climb over 130%. Between the solar industry and artificial intelligence data centers, the world is facing a cumulative 5-year deficit of over 800 million ounces. That is nearly an entire year of global mine production that has vanished from the surface of the earth. The 40% price drop is a temporary financial distortion, not a reflection of reality. The market plumbing is tighter than ever. When we weigh the current macroeconomic data against the two historical anomalies, the conclusion becomes incredibly clear. The massive industrial deficit, combined with the rapid depletion of physical vaults, completely invalidates the 1980 thesis. We are not entering a 20-year winter. Instead, all the underlying metrics suggest that this recent 40% flush out is a manipulated liquidity trap designed to shake out retail investors before the next major cycle begins. It mirrors the exact conditions that preceded the legendary 10 times rally. While short-term volatility is guaranteed, the long-term fundamentals for silver have literally never been stronger. But remember, the paper markets can remain irrational longer than you might expect, so you must manage your risk. As we have seen throughout this analysis, the year 2026 has already been one of the most volatile in history. We saw silver scream to an all-time high of over $121 in January, only to witness a calculated 35% correction driven by massive margin hikes on the futures exchanges. This was not a natural market exit, it was a forced liquidation of the overleveraged. For the first time in 15 years, the gold to silver ratio compressed below 60, signaling that silver is finally reclaiming its role as the high beta leader of the precious metals complex. With global inventories in New York and London falling by over 90 million ounces in the last month alone, the physical window is closing. You have to look past the red numbers on your screen and see the world for what it is. We are in the 6th consecutive year of a structural supply deficit that has removed nearly 1 billion ounces from global reserves. The silver you buy today at $78 or $80 is being priced by a paper system that is currently 500 times leveraged against the actual physical metal in the vaults. When the music stops, there will not be enough chairs for everyone holding a digital contract. If you found this deep dive valuable and it helped you navigate the current market chaos, hit the like button and subscribe to the channel, and I will see you in the next update.